give us a sense, first of all, of how you're concerned or not about U.S. equities, given the cut to the cut that Goldman did to actually U.S. growth.
Hi, Francine. Thank you for having me. Well, I think that cut reflects, in a sense, the anxiety that the markets have been pricing for just a while now. This combination of slowing growth, partly reflecting supply chain issues, and also the relative weakness still of services demand, the headwinds to fiscal policy, but aligned to that also the stickiness of inflation that, as you just reported, is leading to expectations of an earlier liftoff. So it's that combination that people often describe as stagflationary that has really taken over as the narrative from the reflation dominated market perception that has marked most of the last year. And that sort of combination is clearly less positive for equities. But I do think we need to bear in mind that profitability has remained remarkably strong. Secondly, real interest rates are still negative, and that's supporting equities, at least on a relative basis. So although we do think there's going to be lower returns moving forwards, we're not overly concerned about the downside risk to equities from here.
So what does that mean, Peter, in terms of what you want to buy in this kind of environment?
Well, we've been arguing for quite a pro-value orientated approach to portfolios for some time, mainly because we expected that any rise in bond yields and inflation expectations would really support these areas, particularly because of their extremely low valuations. Now, many people have said that value stocks have been value traps for a long time, and indeed that's been true. Underlying fundamentals have been weak for many areas like banks and resources, and also, of course, ever lower interest rates have been more beneficial for long duration growth stocks. But a lot of the value areas, like the banks, like the resources and energy stocks, had until very recently actually reached lower relative multiples in markets than they had even in the worst part of the financial crisis. It's interesting that year to date, the best performing sector in Europe, I think, has been banks, and in the US, both banks and energy. And that's a big change from what we've seen previously. I don't think it's negative for tech stocks, but I think there is more room for this shift to a bit more of a value bias as higher rates are increasingly priced in.